Welcome to LearnCity. Let's talk about bank reconciliation statements. A bank reconciliation statement is a document that's used to compare and reconcile the differences between balance shown in a company's bank account and the balance shown in its own accounting records. It ensures that the company's financial records accurately reflect the transactions and balances related to the bank's account. In ordinary explanation, bank reconciliation statement is a statement prepared by an account holder, for example, the trader or a business, for the purpose of identifying the causes of disagreement or discrepancy between the cash book balance and the bank statement balance, and to reconcile or harmonize the two balances. About items causing discrepancy or disagreement between the cash book balance and the bank statement balance. The first item is items in the cash book but not in the bank statement. Under these items, we have unpresented checks. These checks are issued by the business but are yet to be presented for payment at the bank by the payee. Unpresented checks will be found on the credit side of the cash book but not on the debit side of bank statement. The effect of unpresented check in this instance is to make the bank statement to be higher than the cash book balance. The next one is uncredited check. Uncredited check. These are checks that are received by business and they are being lodged or deposited into a bank but have not been credited in the bank statement. The uncredited checks will be found on the debit side of a cash book but not on the credit side of the bank statement. The effect of an uncredited check is to make the cash book balance to be higher than the bank statement balance. The next one to note is errors in the cash book. The errors in the cash book, these are mistakes of omissions, duplications, wrong figures, and among others, made in the recording entries posted into cash book. The next item is items in the bank statement but not in the cash book. Number one, we have the bank charges. Number two, we have dividends. We have standing order. We have credit transfers. We have direct debit. We have dishonor checks. We have interest received from the bank on fixed deposit. We have interest charged on overdraft or loans. And we also have errors in the bank statement. Having known the meaning of bank reconciliation statement, let's talk about purpose of bank reconciliation statement. The purpose of a bank reconciliation statement is to compare the bank statement provided by the bank with the cash book or general ledger maintained by an individual or company. It involves identifying and explaining any kind of differences or discrepancies between the two records. Furthermore, the other purposes of it are identifying errors. In identifying errors, it helps in identifying mistakes made by either bank or the account holder, him or herself, in recording transactions. Discrepancies can arise due to errors in recording checks, deposits, bank charges, or interest. Another one is ensuring accuracy. By reconciling the bank statement with the cash book, it ensures the accuracy of the financial records. It helps in detecting and correcting any errors or omission that may have occurred during the recording process. Another one is fraud detection. Bank reconciliation statement also serves as an important tool in detecting fraudulent activities. It allows individuals or companies to identify any unauthorized transactions, be it either forgeries or other irregularities that may have taken place. Another one is cash control. Cash control is used in reconciling the bank statement. Cash control helps in maintaining a proper cash, as it ensures that the actual balance available in the bank must match the balance reported in the cash book. This is very vital for effective cash management and avoiding overdraft or insufficient funds. Another point to note is financial reporting. The bank reconciliation statement, it provides accurate and up-to-date information about the company's financial position, as it helps in preparing reliable financial statements such as the balance sheets and income statements, which are very essential for decision making and meeting regulatory requirements. Overall, or in conclusion to it, the bank reconciliation statement plays a very vital role in ensuring the accuracy and integrity of financial records, such as identifying errors, preventing frauds, and maintaining effective cash management. It is very important control mechanism that helps individuals and businesses keep track of their financial transactions, thereby maintaining a financial transparency.